Interesting article in the Wall Street Journal today about mortgage rates and how they could fall fast. So this week we have the Fed meeting and kind of their anticipation is to drop 0.25% in the Fed funds rate. And basically that's already baked into the market for mortgage rates right now. But this article goes into a little bit deeper dive of what the mortgage rates, how they could fall faster. So let's take a look at what that means. And I'm going to dissect this article a little bit. So it's going to take, 5-7 minutes to go through this. And I'll try and explain kind of what some of these things mean in the article because it is a little bit technical. So let's take a look. So this is mortgage rates. They are finally falling, right? So let's take a look at this. Finally falling, and here's why they can move fast on here. So let's take a look. Anxious home buyers sometimes advised to watch the Federal Reserve's next move. Basically, it's not just about the Fed's move. It's about the Treasury long-term bond yields. They've been drifting lower because of a host of factors, including expectations that the Fed is going to continue to start moving rates down. So the 0.25% rate that they're talking about, that's already baked into kind of mortgage rates right now on that. Daily tracker, Mortgage News Daily, 30-year fixed rate hits their lowest level since 2024 at 6.29%. So they are falling. They're moving fast here. A portion of why is the government jobs report, which showed in August basically hiring was at a far slower pace. Unemployment rate started to go up. The overestimation of the number of jobs that were created over the last year was overstated by almost 1 million jobs, 911,000. So that was reduced lower. That happened last year as well. About 800,000 jobs were overstated. So that's kind of the job market is not as in good a shape as we thought, right? So then we're basically talking about the yield, the Treasury yields and the spread that we have between the 10-year yield and mortgage-backed securities. And I'm not going to go into this, but you can see that this has been dropping pretty drastically. This is February, March, April, May, June, July, August, September. So this is just the beginning of September. You've seen this major drop right in here, but they have been dropping over time. And I'll go into that in just a second here. But basically, this rapid move could happen is attributed to what Mortgage News Daily calls the arcane underpinnings of the market. So, and how the bond market looks at the mortgages here. So a standard 30-year mortgage, which are guaranteed by Fannie and Freddie, they're basically sold in buckets. And if you sell them in buckets, let's look at this here. They're the 5% or 5.5% coupon, right? So 5.5% coupon, that gives you mortgage rates between 5.75 and 6.625 is kind of the range of mortgage rates, right? If you do 5%, it's going to be 5.25 to 6.125. Okay, so that's kind of where those rates are. So this is the coupon. And these are kind of the mortgage rates that they trade for, right? So basically this coupon equals a mortgage rate between 5.25 to 6 1/8. This one, 5.5 coupon is mortgage rates from 5.75 to 6.625. I might be off on that a little bit, but at the end of the day, that's how those work, right? So now let's take a look at this article and what the expectations are. So that's what this is right here. Is 6%, 5.5% trades a 6%, there's one at 6%, there's one at 5.5%, there's one at 5%. So what happens is the upshot according to this guy is rates can drop more quickly than normal as they approach the upper limits of the next lower bucket. So let's take a look at that. Let's go to this page here and you can see this is the 5.5% coupon. Remember, those are interest rates between 5.75 up to 6 5.75 up on higher, right? If you look at this 5% coupon, you can see the prices are getting better on those versus the up, like today they're up 13 basis points on the 5.5 coupon. They're up 24 basis points on the 5% coupon. The 5% coupon, let's go back to this, is interest rates between 5.25 and 6 1/8. Interest rates are moving from here down to here. And so they're approaching the higher band of interest rates in the next lower bucket of yields. Okay, so they're normally, right now we're at a 5.5 coupon. They're starting to trade towards and get more steam rolling and better prices at the 5% coupon, which is what we're seeing right here is in this market right here. So we're seeing these up. These are trading better than the 5.5% coupon. This is the 5% coupon. So as they get better down in this lower coupon, you're going to start to see, or you could see, mortgage rates drop faster as a result of that. So let's go to, oops, I did the wrong one here. So let's go to the article that we were at here. So what happens when expectations of future interest rates start to drop, which is the Fed lowering the Fed funds rate another quarter, and then another quarter in a month, and then another quarter in December. That's the anticipation that the Fed is going to move interest rates, the yield down on the 10-year Treasury down to lower levels, right? When that happens, you're going to start seeing better pricing in the market for loans that are now in demand for that lower bucket, the 5% coupon versus the 5.5% coupon. Now, the reason why this is that mortgages at higher rates are more likely to get refinanced and paid back early, creating risk for bondholders to reinvest their money at the lower rates. What does that mean? That means that as interest rates, so we'll go down, right? So if you have an interest rate today of 6.75%, right, or 6.5%, that loan is more likely to be refinanced sooner because interest rates are going down. So this loan for a servicer, for a lender, is only going to be on for a short period of time because interest rates are going down. They're going to refinance that rate once the interest rate comes down. So why is that important? If you were an investor, would you pay more money or less money for a 6.75 interest rate when you think that interest rates are going to go down to 6%, right? Because that loan, if you originate that loan, this loan today at 6.75%, it's only going to be on your books for a short period of time. So if you're going to pay for it, you're not going to pay very much for it. You want a lower yield that is going to be on for a longer period of time. So this loan at 6% is going to take a lot longer to pay off because it's going to be there for a longer period of time. So that is why interest rates are trading better at the lower coupons. These guys, these interest rates are going to stay on for a longer period of time because in order to get to a 4.5% coupon, the rates have to go down a lot more. And so the loans are going to stay here. That's why investors are trading more towards that than they are towards the 5.5% coupon. So that is kind of I'm going to see if there's anything else. They get likely to get refinanced, paid back early. So there's been a shift in investor preferences from the 5.5% coupon bucket to the 5% bucket, which is interest rates from 5.25 to 6.125. So this is kind of why the interest rates can go down faster. It's kind of like a meme stock that like all of a sudden gets a lot of action and the prices on the stock go way up. This is if there's a lot of people that are seeing a recession, seeing the jobs markets collapse, seeing the unemployment rate going up, the long bond, the Fed is going to lower the Fed funds rate, which is going to bring rates down over time. And as they do that, we want to see more investment in the lower 5% coupon, which will get interest rates lower. I hope that made sense to you all. If you have any questions, please feel free to reach out to me. Would love to talk to you more about it. Thanks. Bye-bye.